An adjustable rate mortgage or ARM is a type in which the interest rate changes during the life of the loan. This can be a risky proposition for some borrowers, but ARM loans also have benefits. Let's take a closer look at adjustable rate mortgage explained. Hello everyone, welcome to Wealthy Wisdom. If you're new to this channel, do like and subscribe to the channel. This video will discuss adjustable rate mortgage explained ARM loan 2022. What is an adjustable mortgage or ARM? An adjustable rate mortgage, also known as an ARM loan, is a type of mortgage in which the interest rate changes during the life of the loan. The initial interest rate is usually lower than a fixed rate mortgage but can increase over time. How does an ARM work? With an ARM loan, the interest rate is fixed for a particular time, usually 5, 7, or 10 years. After that, the interest rate can change annually based on changes in a predetermined index such as the yield on U.S. Treasury bills. Benefits of an ARM loan. In this adjustable rate mortgage explained, there are several benefits of an ARM loan including: Number 1. Lower initial interest rate. The initial interest rate on an ARM loan is usually lower than the interest rate on a fixed rate mortgage. This can save you money in the short term. Number 2. Flexibility. An ARM loan can be a good option if you plan to sell your home before the interest rate adjusts. Number 3. Lower your monthly payments. If you have a lower interest rate, your monthly payments will be lower. This can free up money for other purposes such as investing or saving for retirement. Number 4. Potentially higher interest rate. While the initial interest rate on an ARM loan is usually lower than the interest rate on a fixed rate mortgage, it can increase over time. This can help you build equity in your home faster. Lastly, protection from rising interest rates. An ARM loan can offer protection from rising interest rates. If rates rise, your interest rate will only adjust once every 12 months. Risks of an ARM loan. There are also some risks to consider with an ARM loan, including: First, higher interest rate. If the index used to determine the interest rate on your loan increases, your interest rate would also increase. This can cause your monthly payments to go up. Second, negative amortization. If your interest rate increases and you can't afford the higher monthly payments, you may end up owing more on your loan than when you started. This is called negative amortization. Third, prepayment penalties. Some ARM loans come with prepayment penalties. You may have to pay a fee if you pay off your loan early. Fourth, limited choice. There are not as many lenders offering ARM loans as there are offering fixed-rate mortgages. This can make it harder to find a loan that meets your needs. Finally, higher risk. An ARM loan is riskier than a fixed-rate mortgage. If interest rates rise, you could repay more on your loan than your home is worth. When to consider an ARM loan? When considering an ARM loan, it's essential to understand the risks and rewards. An ARM loan can be a good option if you plan to sell your home before the interest rate adjusts. It can also be a good choice if you are comfortable with the risks and are confident that you can afford the higher payments if rates rise. Talk to a financial advisor if you're unsure whether an ARM loan is right for you. They can help you understand the risks and rewards of an ARM loan and compare to other types of loans. If you like this video, don't forget to like and subscribe to the channel. What are the types of ARM? There are many ARM loans, each with its own terms and conditions. Some common types of ARM loans include: Number 1. 5/1 ARM. This type of loan has a fixed interest rate for the first 5 years and then adjusts annually. Number 2. 7/1 ARM. This type of loan has a fixed interest rate for the first 7 years and then adjusts annually. Number 3. 10/1 ARM. This type of loan has a fixed interest rate for the first 10 years and then adjusts annually. Number 4. Hybrid ARM. This type of loan has a fixed interest rate for a certain period and then adjusts annually. The initial fixed rate period can be 3, 5, 7, or 10. Number 5. Interest-only ARM. This type of loan has a lower interest rate for the first few years and then adjusts annually. You will only have to pay interest on the loan during the initial period, not the principal. Number 6. Negative amortization ARM. This type of loan has a lower interest rate for the first few years and then adjusts annually. However, if your payments don't cover the total amount of interest, the unpaid interest will be added to your loan balance. This can cause you to owe more on your loan than when you started. Number 7. Option ARM. This type of loan allows you to make interest-only, minimum, or total payments. If you make minimum payments, your loan balance will increase over time. Number 8. Balloon ARM. This type of loan has a lower interest rate for the first few years and then adjusts annually. However, at the end of the initial period, you will be required to pay off the entire loan balance in one lump sum. Finally, adjustable rate jumbo mortgage. This type of loan is like a regular ARM loan, but the loan amount is higher than what is considered conventional. Jumbo loans typically have higher interest rates than traditional loans. When choosing an ARM loan, it's essential to compare different loans and select the one that best meets your needs. You should also ensure you understand all the terms and conditions before signing any paperwork. How to qualify for an ARM loan? To qualify for an ARM loan, you must have good credit and employment history. You will also need to prove that you can make the higher payments if interest rates rise. When applying for an ARM loan, your lender will look at many factors to determine whether you qualify. These factors include your first, credit score. Your credit score is a significant factor in determining whether you qualify for an ARM loan. Lenders typically require a minimum credit score of 620 to 640. Second, employment history. Your employment history is another important factor in determining whether you qualify for an ARM loan. Lenders will want to see that you have a steady job and income. Third, debt-to-income ratio. Your debt-to-income ratio is the number of your monthly debt payments divided by your monthly income. Lenders typically require a maximum debt-to-income ratio of 43%. Fourth, loan-to-value ratio. Your loan-to-value ratio is the amount of your loan divided by the appraised value of your home. Lenders typically require a maximum loan-to-value ratio of 80%. Finally, reserves. Your reserves are the funds available to make your mortgage payments if you lose your job or have another financial setback. Lenders typically require that you have 2 to 6 months worth of mortgage payments in reserves. When applying for an ARM loan, compare different loans and choose the one that best meets your needs. You should also ensure you understand all the terms and conditions before signing any paperwork. So there you have it, an adjustable rate mortgage explained. When considering taking out a mortgage, weigh all your options and make the best decision for your unique financial situation. Thank you for watching. I hope you have learned something from this video. If you like this video, give us a like, subscribe to the channel, and comment below. Thank you and goodbye.